Most people in the UK think that if you sell something and make a profit, HMRC automatically wants a cut. But that's not actually true. There are certain assets that you can sell, make a genuine profit on, and in many cases pay absolutely no capital gains tax at all. And no, this isn't a loophole, it isn't anything dodgy, and it isn't something only wealthy investors know about. These are legitimate, well-established rules that exist in UK tax law right now in 2026. On this channel, we talk a lot about retirement planning, building wealth steadily, and making your money work harder without taking unnecessary risks. One of the most overlooked parts of that is understanding which assets are tax efficient by design. Because it's not just about how much you earn or how much your investments grow, it's about how much of that growth you actually get to keep. So in this video, we're going through 6 assets that are generally free from capital gains tax in the UK. We'll break down why each one is exempt, where the exemption has limits, and where people commonly get caught out. Stick with it to the end, because number 6 is the one that affects almost every homeowner in the country. And there are a few conditions people don't realize apply to them. Let's start with number 1, gold and silver coins. Now, here's the first thing to understand, because this trips a lot of people up. Not all gold is treated the same by HMRC. If you buy a gold bar, that is not exempt from capital gains tax. If you buy a foreign coin, like a South African Krugerrand or a Canadian maple leaf, that is also not exempt. But if you buy specific UK legal tender bullion coins, ones that are backed by the government, those can be completely free from capital gains tax. The coins that qualify include Britannia gold and silver coins, gold sovereigns, including half sovereigns, and the Queen's Beasts range produced by the Royal Mint. The reason these are exempt comes down to one specific detail. Because they are legal tender in the UK, HMRC treats them the same way it would treat currency, and currency itself is not subject to capital gains tax. That's the mechanism behind the exemption. It's actually one of the reasons the Royal Mint promotes these coins directly to investors, because the tax advantage is a genuine selling point. So, if you're someone looking to add physical gold to your portfolio as a way to diversify or as a hedge against inflation, the type of gold you buy actually matters just as much as the price you pay for it. Buying the wrong type could mean you're liable for tax on the gain. Buying the right type could mean the entire profit is yours. Now, a lot of you will be thinking about gold jewelry and whether that falls into the same category. It doesn't, but it does fall into a separate category, which brings us to point number 2. Personal possessions, sometimes referred to as chattels. Under UK tax rules, you generally don't pay capital gains tax when you sell a personal possession for less than £6,000. This is called the chattels exemption. So, if you bought a watch for £1,000 and later sold it for £5,000, that £4,000 profit would not be taxed because the total you received falls under the £6,000 threshold. This becomes far more relevant once you're dealing with higher value items. Think designer handbags, jewelry, antiques, art, and other collectibles. We've all seen the surge in resale value of certain luxury handbags over the past few years, some of which now sell for tens of thousands of pounds. Once the amount you receive for an item like that goes above £6,000, the exemption no longer applies in full, and there may be capital gains tax to pay on the profit. There's also a rule that catches people out specifically around sets. Let's say you own a matching jewelry set, a necklace, a bracelet, earrings, and a ring. If you sell each piece separately, each one for under £6,000, you might assume you're covered by the exemption on all 4 sales. But HMRC has a specific rule for sets like this. If the items are considered part of a matching set, the £6,000 threshold can apply to the value of the whole set combined, not each item individually. So splitting the sale doesn't necessarily get around the rule. One more detail worth knowing here. There isn't a sudden cliff edge the moment you go over £6,000. There's a specific form of relief that applies to personal possessions sold for between £6,000 and £15,000, which limits how much of the gain becomes taxable. It's a gradual increase rather than the full gain suddenly becoming liable the moment you cross that line. If this is useful so far, this is a good point to hit subscribe because we cover practical tax and retirement planning content like this every week, and it genuinely helps more people find the channel when you do. Now, number 3, whiskey casks. This one surprises a lot of people because it sounds like it shouldn't be true, but it is. Whiskey maturing in a cask can be sold completely free of capital gains tax. The reason comes down to how HMRC classifies the asset. Whiskey in a cask is treated as what's called a wasting asset because as it matures, it evaporates. This is often referred to as the angel's share because of that natural evaporation. The whiskey is considered to have a predictable useful life of less than 50 years. Assets that meet that definition of a wasting asset fall outside the usual capital gains tax rules that apply to things like the personal possessions we just covered. That means you could buy a cask, hold it for several years while it matures, sell it for a significant profit, and the entire gain could be free from capital gains tax, as long as it stays in the cask the whole time. It's worth understanding the difference between this and the VAT and duty side of things. While the whiskey is maturing in a bonded warehouse, VAT and duty are suspended. That's a completely separate issue from capital gains tax. The capital gains exemption is purely because of the wasting asset classification while the spirit remains in the cask. If you were to go ahead and bottle that whiskey and then sell the bottled product, it stops being treated as a wasting asset in the same way, and the standard non-wasting chattel rules would apply instead, including that £6,000 threshold we mentioned earlier. One thing to flag here: if someone is buying and selling whiskey casks so frequently and in such volume that it starts to look like a trading activity rather than an investment, HMRC could argue that trading tax rules apply instead of capital gains tax rules. For most people who are simply holding a cask or two as a long-term investment, that isn't a concern. But it's worth understanding the distinction, particularly if you're considering this as a more active strategy. This tax treatment is a big part of why whiskey cask investing has grown so much in popularity in the UK over recent years. But as with any investment, it's worth doing proper due diligence on the company or broker you're buying through. Number 4, stocks and shares held within an ISA. This is probably the most well-known entry on this list, but it's worth including because so many people still aren't using it to its full potential. An ISA, or individual savings account, is a tax wrapper. That means any investments held inside it grow completely free from capital gains tax. On top of that, any dividends you receive from investments held in a stocks and shares ISA are also free from income tax. For the current tax year, you can contribute up to £20,000 into your ISA allowance. And that limit can be split across different types of IS as if you want. Realistically, most people in the UK aren't anywhere near using their full allowance every year, which means there's often significant unused tax-free growth potential being left on the table. It's also worth noting that from April 2027, there are some changes coming to cash, ISA contribution limits specifically. That doesn't affect the stocks and shares ISA allowance, but if part of your strategy involves cash savings, it's worth keeping an eye on how that develops closer to the date. For anyone building a retirement portfolio, maximizing ISA contributions before looking at other investment accounts is usually one of the most efficient first steps, purely because of how much tax-free growth and income you can generate inside that wrapper over time. Number 5, UK government gilts. A gilt is essentially a bond issued by the UK government. When you buy a gilt, you're effectively lending money to the government, and in return, you receive interest payments over a fixed period before getting your original investment back at maturity. What a lot of investors don't realise is that gilts are generally exempt from capital gains tax. So, if you buy a gilt and later sell it at a profit, that profit is not subject to capital gains tax. This applies whether you hold the gilt to maturity or sell it earlier on the secondary market at a higher price than you paid. It's important to separate this from the interest income you receive while holding the gilt. That interest is subject to normal income tax rules. So, depending on your other income for the year, some or all of that interest could be taxable. Because of this, some investors specifically look for low-coupon gilts, meaning gilts that pay a smaller amount of regular interest, but are more likely to be sold at a discount and produce a larger capital gain when sold or matured. Since that gain is generally tax-free and the interest portion is minimized, this can be a more tax-efficient structure, depending on someone's individual circumstances. For anyone in or approaching retirement who's looking for more predictable, lower-risk fixed-income exposure, gilts are often worth understanding properly, not just for the returns themselves, but for how those returns are taxed. And finally, number 6, your main home. This is the one that applies to the largest number of people, and it's called private residence relief. When you sell your main home, you generally don't pay capital gains tax on any profit you make, but automatic qualification for that relief depends on meeting a specific set of conditions, and it's worth understanding them properly because they don't apply automatically in every situation. First, the property needs to have been your only or main home for the entire period you owned it. Second, you can't have used part of the property exclusively for business purposes. Third, the total area of the property, including any outbuildings and grounds, needs to be under 5,000 square meters. And finally, you can't have purchased the property purely with the intention of making a profit from reselling it. If all of those conditions are met, you can generally expect to pay no capital gains tax at all on the sale of your main home, regardless of how much the property has increased in value. Where this becomes more complicated is if you own more than one property. This includes buy-to-let properties, holiday homes, or a second residence. If you've lived in one of those additional properties as your main home for part of the time you owned it, you may still be entitled to partial private residence relief, meaning only a portion of the total gain becomes taxable, based on how long the property was genuinely your main residence compared to how long it wasn't. This is an area where a lot of people either overpay unnecessarily because they don't realize partial relief applies, or underpay because they assume the relief covers a property it doesn't actually qualify for. If you're in a situation involving multiple properties, it's worth getting proper advice specific to your circumstances, because the rules can shift significantly depending on the details. So, to summarize, the 6 assets we've covered are certain UK legal tender gold and silver coins, personal possessions sold under the relevant thresholds, whiskey maturing in a cask, investments held within a stocks and shares, ISA, UK government gilts, and your main home under private residence relief. Everything covered in this video relates to assets that are generally treated as exempt from capital gains tax under current UK rules. It's important to say that tax rules can and do change. Individual circumstances vary, and if you're dealing with a significant sale or a more complex situation, it's always worth speaking to a qualified accountant or tax advisor before making any decisions. This video is intended to give you a clear general understanding of how these exemptions work, not personalized financial advice. If you found this useful, subscribing to Albert State Pension helps more people planning their retirement find content like this, and we'll be covering more practical, tax-efficient strategies in upcoming videos. Thanks for watching, and we'll see you in the next one.